Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at that US inflation number which came out. We'll also have a look at the growth number that came out of the US. And finally, we've got quite a bit on SA. We'll have a look at consumer confidence in SA. And also, we'll have a look at when the South African market has typically done well relative to the US. We're going to start off with the core PCE inflation print. Last week, PCE inflation came out. It is the preferred inflation measure for the Fed, and core PCE inflation is proving to be pretty sticky at 2.9%. Now, if we get into the detail a little and you look at core PCE inflation over the past 3 months, annualized, that's running at 3%. Over the past 6 months, it's running at about 2.5%. So if you're the Fed and you have a look at this, it would be a bit concerning. It suggests that inflation is proving to be sticky at that 3% level. The latest run rate is around 3%, and there's little reason at this point to expect that in core PCE inflation is going to be rolling over or declining anytime soon. And that by itself would make life quite difficult for the Fed. But to counter that, US growth is proving to be very strong. Last week, we saw a revision to Q2 GDP growth for the US, and the revision suggests that growth in the US in the second quarter was running at 3.8%. That was well above the consensus forecast of 3.3%. Now, it is expected that growth is going to slow in the US, and we'll touch on that expectation shortly. But it is important to note, from a Fed's perspective, you look at the situation at the moment, you've got inflation, which is running hot, and growth, which is running hot. There's little reason to cut. And I suspect part of the focus from the Fed going forward is going to be trying to resolve is why we're seeing such strong GDP numbers while we're seeing such weak labor numbers. There's a massive disconnect. Either there's been this huge improvement in productivity, or one of these series is not completely accurate, and we're likely to see some sizable revision. So that is the difficulty for the Fed. The labor market's weak, but GDP growth is strong and inflation is strong. Either way, the market pricing in 4 cuts over the coming 12 months does seem at this point to be a little bit optimistic. Post the GDP number coming out, we did see an upward revision to US growth forecast for this year. And it's just the start. It typically takes a couple of weeks at least for all the contributions to consensus to reflect a change in the data like we've seen. So we can expect over the coming couple of weeks some fairly persistent upgrades to US growth forecasts for this year, simply as a result of the better than expected Q2 number. But in addition to that, it looks like Q3 growth is going to be very strong. The Atlanta Fed GDP Now estimate, which is a very high frequency estimate of economic activity, is running at 3.9%, above the 3.8% in Q2, but importantly, well above the 1.7% that's currently expected in Q3. So we've got a set of economic data that suggests that the US economy at this point is pretty strong. And this too is going to go into the Fed's thinking. We've got an environment where inflation quite clearly is sticky and running at 3%, and GDP activity is running at close to 4%. And I think the key question that the Fed is going to have to answer over the coming meetings is, why is it that we're seeing such strong economic activity with a weakening labor market? That's pretty unusual. Either there's been a sudden massive improvement in productivity, which seems unlikely, or one of those two series, growth and employment, is going to be revised in time. And that makes it quite difficult for the Fed because you're going to be acting on data which is going to be revised later on. And the key question the Fed has to ask is, which of these two series at this point in time is painting a more accurate picture of the US economy? Is it the GDP numbers, in which case there's little reason to cut at all? Or is it the labor data, in which case there's reason to cut quite aggressively? And that, again, I think is going to be the key debate in the Fed. At the moment, the market is expecting 4 rate cuts over the coming year. And it is interesting that when this GDP number came out, which was so strong, we did see the S&P 500 pull back a bit under the basis that the Fed would be less likely to cut over the coming year. So I think that expectation in the market of 4 is quite optimistic at this point. Given the data we're seeing, the inflation data, the GDP data, it's likely that the Fed will cut by less than that, which would then be a headwind for US equities. Just another headwind to look at, and that's consumer confidence in the US. Again, it's quite anomalous. You've got the situation where growth unequivocally is quite strong, But consumer confidence, whichever survey you look at, is looking pretty weak. And there's two stories to this, I think. The first is an inequality story. In the US, while the median expectation is quite weak, and median consumer confidence is quite weak, what that masks is a pretty sizable divergence of consumer expectations between those that have a lot, the wealthy, and those that don't have a lot. And consumer confidence for the well-off is currently running at 5-year highs. Consumer confidence for the low end is running at 5-year lows. So you look at the average, and that suggests a pretty weak consumer confidence, but the economy is not equally weighted. Top end, the top 10% of income earners in the US account for 50% of consumption. So the top end is actually quite optimistic, and that's feeding into some pretty strong consumption numbers for the top end, and that, because of its importance, actually leads to some pretty resilient growth. So that's how I think we can reconcile these differences. So there's two aspects to it. One is the consumer confidence numbers are the average person in the street, and we should actually weight the top end by more to get a gauge of economically significant consumer confidence. And the second point is that the top end is spending a lot, and I think that's how we reconcile the mediocre to weak consumer confidence numbers with the pretty strong economic data in the US. Switching to South Africa, just like the US, we've seen a reduction in consumer confidence, and that's been linked to a number of different factors. But that series does reconcile with the SARB's business cycle indicator, which has also been flat over the past few months, suggesting a pretty stagnant economic environment. And that series also correlates with our SOE index, which has shown very little improvement over the past 6 months or so. So we're seeing a range of indicators that suggest that economic activity has been pretty weak over the past 6 months or so. We also have a set of indicators that suggest that it's likely to pick up. If you look at the latest high-frequency data from Eskom, for example, the energy availability factor is very strong for this time of the year. And there's other indicators too that suggest the South African economy is likely to accelerate. A lot of them are linked to commodity prices, which have been quite buoyant. So our expectation is that while growth has been weak, we're going through a soft patch, and we're likely to see economic activity in South Africa pick up. It would appear that view is largely expressed in the market. If you look at the performance of the South African equity market over the past 5 years, we've seen a very strong rally over the last year, and that's led to performance of the last 5 years now sitting in the top third of countries across the globe, measured in dollars. And of course, the performance of the South African equity market over time will fluctuate, and there have been periods over the past 15 years or so where 5-year performance for South Africa has been in the top 20% of countries, and there's been periods where it's been in the bottom 10%. But given the surge in commodity prices and the potential for an improvement in the SA economy, what we have seen of late is that the South African equity market has been very good and is now again sitting in the top third. It's interesting to note that as South Africa's equity performance has improved relative to the rest of the globe, we've seen this deterioration in the US equity performance relative to the rest of the globe, to the extent that South African equity performance over the past 5 years has actually outpaced that of the US. And if we go back over time, there is a relationship. When South African equity performance has been very weak, US equity performance has been very strong. And when US equity performance has been very weak relative to the rest of the globe, South African equity performance has been very strong. And I think the underlying causal mechanism here is the dollar. When the US economy is typically very strong and has been strong for a period, and the dollar is stronger, US equities in that environment tend to do well relative to the rest of the globe. But when the dollar weakens, as it has recently, that typically is associated with a commodity price strength, which is very helpful for a commodity exporting country like South Africa. Dollar weakness equals rand strength, equals euro strength. And we land up with currency strength in other countries that reduces inflation problems, that reduces the hawkish bias from central banks. And in addition to that, the boost in commodities in South Africa's case typically leads to improvements for the fiscal situation for the government, and ultimately that reduces the need to raise taxes. So there's all these linkages that come through from commodities and from the dollar, and that means that ultimately South African equity performance tends to be quite different from the US. And the two together reduce volatility in a portfolio. So the US is a good diversifier for South Africa, and South Africa or other commodity exporting countries would be a good diversifier for the US. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.